The story from Howard Marks then is it's time to get out, and he'd rather get out too quickly than hang around and be too late to get out. Your comments back to that?
It's interesting. So I think it's always difficult to use valuations as a timing signal. We do know that high valuations will typically lead to lower future returns out in the future, and that's what we try to express with our clients. But if you're just trying to look at the FANG stocks or any other kind of group of technology stocks as a proxy for when to get out of the market, so we think that's actually false. And I would say too, the business models of some of these really super tech companies is sound, we think, and actually is kind of changing the way that we work across our economy, but obviously just in terms of general e-commerce as well.
Yeah.
So I would push back a little bit against that.
The VIX, he seems to bring that up as well and say it says more about how people feel about what volatility is going to be in the future, not necessarily what it will be in the future, and maybe a sign of complacency there?
We don't have that feeling actually at BlackRock that the low VIX is a reading a sign of complacency. I think there's this kind of worry that we're going to have a mean reversion of volatility, whether it be implied or realized. But when we step back and we do a lot of our work, we understand, yes, the Fed and other central banks have suppressed volatility, but that's also a very simple argument. So what we try to do is step back and say, is there a linkage between macroeconomic variables and low financial market volatility? And actually what we found, if you look at some of those traditional variables that we would include as macroeconomic variables, GDP, employment, inflation, the volatility of those variables is a lot lower in this decade relative to prior decades. And so we think there's actually strong linkage, and that this low volatility is actually supported by the low macroeconomic volatility environment.